Welcome to this explainer. Today, we're diving into some seriously eye-opening source material about the urgent realities of the 2026 tax landscape. Look, if you're a solo entrepreneur, the ground beneath your feet has totally shifted. So let's unpack the exact strategies outlined in the research to keep you perfectly compliant and, more importantly, help you hold on to your hard-earned revenue. Okay, let's quickly go over our roadmap for navigating these new regulations. We'll start with the 2026 tax cliff reality check, move into strategic entity elections, explore pension and healthcare arbitrage, break down the 2026 compliance routine, and then finally look at future-proofing your wealth. All right, diving right into Section 1, the 2026 tax cliff reality check. So here is a massive reality check from the source material, the 20% qualified business income deduction, the QBI that so many of us relied on for years as a straight discount on taxable income, is dead. It's gone. If you're still rocking an off-the-shelf LLC from last year and expecting that old deduction to save you, you are virtually guaranteed to overpay federal rates. You're basically volunteering to leave a giant tip for the IRS. But hey, it's not all bad news. We have a lifeline here. The government didn't just take away deductions, they replaced the old system with these new 2026 tiered incentive programs. This is a newly enacted federal structure designed specifically for microbusinesses. Honestly, understanding these new tiers is absolutely crucial for stopping your cash bleed and getting your tax burden back under control. Moving right along to Section 2, Strategic Entity Elections. Okay, so this is where you really need to pivot. Choosing between a basic, outdated, disregarded entity and a fully optimized 2026 compliant S-Corp election is no longer just some boring paperwork. Sticking with the old setup leaves you totally exposed. Making the move to an optimized S-Corp is quite literally the most critical fork in the road for unlocking massive new tax savings. And here is exactly why that S-Corp election is so powerful. It unlocks these brand new solo cap deductions. But the research points out a major catch. These new federal deductions only trigger maximum benefits when you hit very specific income thresholds. You have to strategically structure your setup to hit those marks, because that's the exact moment these powerful deductions activate and start working in your favor. Now, administratively, you can't just declare you're an S-Corp and call it a day. The sources explicitly warn that without specific mandatory 2026 clauses formally written into your operating agreement, you are completely locked out of the updated home office and equipment credits. The IRS checks the fine print, so your documentation absolutely has to match. All right, time for Section 3, Pension and Healthcare Arbitrage. Let's go on the offense for a minute. The new code introduces these 2026 Green Health Solo mandates. By strategically applying these into your business immediately, the data shows you can legally and drastically slash your adjusted gross income. It's an amazing way to turn everyday expenses into aggressive deductions. There's also a massive arbitrage opportunity here. The research highlights this really interesting gap between the new solo 401k limits and the heavily revised alternative minimum tax, which is basically a baseline tax floor set by the IRS. By maximizing your solo 401k contributions, you're actively playing the spread against those new baselines to keep your current tax liability as low as humanly possible. This source text calls this next provision an absolute game changer, and for good reason. It's the primary residence nexus rule. This 2026 IRS provision gives you the exact legal mechanism you need to shift everyday personal expenses straight into deductible business overhead. When you apply this correctly, the line between living expenses and working expenses becomes a highly optimized advantage. Which brings us to Section 4, the 2026 compliance routine. Now, you know with big deductions comes big IRS scrutiny, right? To survive the stricter 2026 audit guidelines, you have got to follow their new digital rules. For first-year solos, the IRS absolutely mandates 3 things: digital expense categorization, real-time mileage tracking, and automated receipt linking. Throwing paper receipts in a shoebox, yeah, those days are officially over. Without these systems, your deductions are simply disallowed. So how do we handle all this tracking without losing our minds? The source material highly recommends the quarterly true-up method. It's a simple 3-step routine. You reconcile your monthly operations, verify those digital tracking logs, and then capture your new monthly operational incentives. It is perfectly designed to lock in your benefits safely without triggering any IRS red flags. And I literally cannot stress this enough. The documentation issues a massive warning about maintaining a strictly dedicated business bank account.
If you mix personal and business funds, auditors will use the new 2026 guidelines to execute a piercing of the corporate veil. That means they completely bypass your LLC's protection and come directly after your personal assets, like your house or your savings.
Okay, last but not least, Section 5, future-proofing your solo wealth. Look, a successful solo business doesn't just stay in one place. When your revenue inevitably blasts past that 2026 first-tier deduction bracket we talked about earlier, your LLC structure has to proactively scale right alongside it. The research points out that what works beautifully in the first tier will actively hurt you at the next one. You've got to forecast your revenue before the year ends, not after. Based on everything we've covered in this explainer, your immediate next steps are crystal clear. You need to finalize your updated 2026 registration with those mandatory clauses included. You need to get your banking structures strictly separated, and you need to start claiming these current federal tax breaks today, way before tax season actually sneaks up on you. As we wrap up and you work on locking in your 2026 compliance, I want to leave you with this really provocative thought from the source text. Are you already structuring your exit-ready documentation to survive the massive tax law shifts we know are coming in 2027? Because building true wealth isn't just about surviving this year's tax cliff, it's about staying perpetually ready for whatever comes next.